Welcome back to The Explainer. Okay, let's dive right into this. Today we are absolutely tearing apart one of the most fiercely debated, highly polarizing topics in the market right now. We are talking about Marvell technology, ticker symbol MRVL. Now, if you have been paying even a tiny bit of attention to the semiconductor space over the last few quarters, you absolutely know that AI infrastructure is literally the undisputed king of the hill right now. But the sheer explosive market performance of Marvell recently has everyone completely divided. People are arguing constantly. Is this a generational wealth-building opportunity? Are we looking at the next titan of tech? Or is this just a massive, completely overblown hype bubble just waiting to burst and wipe out retail portfolios? To help us separate the actual signal from the absolute noise, I am joined by our chief investment analyst. Doctor, it is absolutely great to have you here to break down the cold, hard reality behind all of these sensational headlines. Thank you for having me. It is absolutely essential that we look completely past the market emotion today. We must focus strictly on what the data and the actual financial statements are telling us. The numbers paint a very specific structural picture of exactly where Marvell is positioned in the broader artificial intelligence supply chain, and we need to logically understand the underlying mechanics before drawing any conclusions about its valuation.
Well, speaking of numbers, wow, this is crazy. 265%. I opened up my stock accounts recently, and I literally had to rub my eyes to make sure I wasn't seeing things. I thought it was a glitch. Marvell's stock shot up by a stunning 265% over a single one-year period. I mean, that completely blew the tech-focused NASDAQ Composite Index out of the water. The NASDAQ only saw a 42% jump in that exact same time frame, which is normally great, but Marvell just left it in the dust. And recently, we saw the stock trading around $290 a share with a market cap pushing $192 billion. We even saw trading volume reach a staggering 111 million shares on a single day. That is 257% above its historical average. OMG! What on earth is going on with our stock accounts? Why is the market swarming this particular company with such absolute, unbridled frenzy? The trading volume and the extreme price action you were referring to are driven entirely by specific forward-looking growth metrics. If you look at the data here, the market is aggressively pricing in a massive acceleration in their data center revenue, specifically tied to accelerated computing. This 265% surge is not random. It is a direct mathematical reaction to consecutive quarters of management raising their revenue guidance, combined with the company officially securing major, multi-billion-dollar design wins for custom AI processors. It is proven by the numbers that institutional capital is currently rotating heavily into the secondary derivative plays of the AI boom, meaning the companies that supply the foundational components.
Okay, but let's be real for a second here. It's not just the dry financial guidance whipping the market into a frenzy, right? It's wild, headline-grabbing statements like this. Jensen Huang, the CEO of NVIDIA, who is basically the undeniable poster child of the entire AI boom right now, literally stood on stage, pointed directly at Marvell and said, "Ladies and gentlemen, the next trillion-dollar company." He literally said that. He didn't mince words at all. And NVIDIA even announced a massive strategic partnership with Marvell through NVLink Fusion, and they threw a $2 billion investment their way just to advance AI infrastructure. So I have to challenge you here, Doctor. Is this actual, real, fundamental growth we are witnessing, or is this just pure, unadulterated market mania fueled by a celebrity CEO's endorsement? Because a $2 billion stamp of approval from Jensen Huang is definitely going to make retail investors go crazy.
While Mr. Huang's quote undoubtedly generates significant retail interest and headline velocity, as analysts, we must ignore the emotion entirely and focus strictly on the fundamental catalysts. The underlying data proves this is not merely hype, it is a structural shift in data center architecture. The NVIDIA partnership specifically targets integrating Marvell's advanced optical interconnects and silicon photonics directly into next-generation GPU clusters. So, stripping away the rhetoric, there are three real, verifiable, data-backed causes driving Marvell's actual, tangible revenue expansion today.
Let me break this down for you logically, step by step. The revenue growth is anchored entirely in these three pillars of accelerated infrastructure. First, custom silicon. Hyperscalers like Microsoft and Amazon require highly specialized computer chips, known as custom XPUs, because standard off-the-shelf merchant silicon is simply no longer power efficient enough for their unique, massive AI workloads. Second, advanced switching. Marvell's recent launch of the Teralynx T100 switch and their 51.2T Ethernet scale-out switches provide the massive network capacity required to seamlessly link tens of thousands of individual AI chips together without data bottlenecks. And third, optical interconnects. We are seeing unprecedented demand for their 800G and 1.6T scale-out optics. These are the actual physical hardware pathways that allow vast amounts of data to move between server racks and entire data centers, essentially at the speed of light.
Wait a minute, Doctor, hold on. You are throwing a lot of really heavy engineering jargon at me right now. 1.6T scale-out optics, 51.2T Ethernet switches, custom XPUs. What does that actually have to do with our stock accounts? That's way too complicated. And honestly, if I'm investing my hard-earned money, I need to know what they actually do. Could you give a simple analogy that even an elementary schooler could understand? If I'm buying Marvell stock today, what exactly am I buying?
Certainly. Let's simplify the architecture significantly. If you look at a modern AI data center like a massive, newly built industrial megacity, NVIDIA is the company selling the ultra-high-performance factories. Marvell's business is acting as the custom architects and the plumbers of that city. They design the highly specialized, custom-built blueprints for those factories. That represents the custom silicon. And equally importantly, they physically build the high-speed data pipes in the superhighways, which are the switches and optics, that physically connect all of these isolated factories together so they can actually communicate, transfer materials, and share resources. Without Marvell's advanced plumbing, those multi-million-dollar NVIDIA factories would sit completely isolated, useless, and incapable of training massive artificial intelligence models.
Oh, wow. Okay, that makes so much more sense. So in super simple terms, what you're saying is Marvell provides the absolutely essential nervous system and the customized brain power that hyperscalers absolutely cannot function without. They are literally the ultimate AI plumbers. I love that. Okay, so let's move over to the financials and see how this high-tech plumbing business actually translates to the bottom line. Are they actually making money off all these data pipes?
The payoff is proven strictly by the numbers. Let's examine the Q1 fiscal 2025 financial release to understand their current operational velocity. During this period, Marvell delivered a record net revenue of $2.418 billion. This is not a speculative or projected figure. It represents a hard 28% year-over-year growth based on closed contracts. Furthermore, management guided second quarter revenue to a midpoint of $2.7 billion, which mathematically accelerates that growth trajectory to 35% year-over-year. The CEO, Matt Murthy, stated directly on the earnings call that they are seeing exceptional AI-related bookings, which is what allowed them to confidently raise their total revenue outlook for both fiscal 2025 and 2026 by an aggregate of $500 million. This financial growth is directly tied to the mass deployment of those 800G optics and custom XPU solutions we just discussed. Okay, 28% growth up to $2.418 billion in a single quarter, and accelerating to 35% growth next quarter. I mean, that sounds absolutely fantastic on the surface. But wait a minute, let's look under the hood here, because I dug into those exact same financial statements you're referencing, and I saw something that raised a massive, glaring red flag for me as an investor. Something doesn't add up. I have to play devil's advocate here. They pulled in $2.4 billion in revenue, right? And they are supposedly making great money, and their adjusted non-GAAP net income is sitting pretty at a massive $718 million. But if you look at their actual, legally standardized GAAP net income, it is only $34.5 million. That translates to a mere 4 cents per diluted share. 4 cents. Doctor, why is the market going completely wild and bidding this stock up 265% when their actual, on-the-books, legally reported profit is barely scraping by at $34.5 million? Are investors just completely ignoring reality and buying into a fantasy here? Why is there such a huge gap between the adjusted numbers and the real numbers? Investors are not ignoring reality. Rather, institutional capital is strictly analyzing the structural causes of that discrepancy. It is crucial to understand the mathematical difference between core operating cash flow and required accounting deductions. Marvell's actual cash flow from operations for the first quarter was $638.8 million, which was a record high for the company. The gap between the $34.5 million GAAP and the $718 million non-GAAP net income is mathematically traceable to specific strategic investments that depress paper profits today but secure massive future market share. If you look at the reconciliation data in their earnings report, the discrepancy is proven by the numbers to be tied primarily to non-cash expenses. First, there is heavy stock-based compensation, which is a standard structural requirement for retaining top-tier engineering talent in the highly competitive semiconductor space. Second, and vastly more importantly, is the amortization of acquired intangible assets. Marvell recently completed strategic, aggressive acquisitions of companies like Celestial AI and XConn to bolster their technological portfolio. While standard accounting rules, GAAP, require Marvell to amortize the cost of these acquisitions over time, effectively dragging down the paper profit, these acquisitions actively contribute to current and future revenue in the optical, interconnect, and memory pooling sectors. Their non-GAAP gross margin of 58.9% far better reflects the true underlying profitability of the core hardware being manufactured and sold.
Really? Okay, so what you just said basically means they aren't actually burning cash on their day-to-day operations at all. They are just taking big accounting hits on paper because they are aggressively buying up smaller, highly specialized tech companies to build out this impenetrable AI plumbing monopoly. and they are paying their elite engineers and company stock to keep them happy and prevent them from fleeing to massive competitors like Broadcom. Okay, that actually makes a ton of sense when you break it down like that. So let's pivot to the broader industry environment and talk about this economic moat they are building.
To understand the true strength of their economic moat, we must look closely at their data center revenue trajectory. Currently, in fiscal year 2025, their cloud AI revenue sits at approximately $3.7 billion out of a total $4.2 billion data center pie. However, the critical metric for investors to watch is the structural shift in their product mix. In Q4 of fiscal 2025, custom silicon made up over 25% of that pie. Their stated future target is for custom silicon to account for greater than 50% of their total data center revenue. The industry data shows the custom XPU market is growing at a massive 47% compound annual growth rate, and Marvell is systematically targeting a 20% total market share in custom compute alone. They are intentionally shifting their entire business model away from generic parts and toward this highly specialized, highly lucrative sector. Wow, okay, so they are aggressively, intentionally pivoting away from just selling standard off-the-shelf parts to making completely bespoke, tailor-made chips the absolute core of their entire business. But why? Why is custom silicon such a ridiculously powerful moat? What stops a multi-trillion-dollar behemoth like Amazon or Microsoft from just doing this completely by themselves or simply taking their massive budgets over to another competitor?
The barrier to entry in this space is massive. Developing a custom 2-nanometer AI chip is not a simple transactional purchase. Marvell provides an irreplaceable end-to-end, full-service lifecycle. They don't just print the chip and ship it. They co-develop the system architecture years in advance alongside the hyperscalers, constantly iterating on highly complex power and performance trade-offs. They provide the design IP, which includes the hardened SerDes interconnects and custom high-bandwidth memory architectures that are incredibly complex and expensive to engineer. Furthermore, they handle the advanced multi-chip packaging, and finally, the silicon services, the manufacturing oversight, and the global supply chain logistics. Hyperscalers rely on Marvell because replicating this 2-decade history of trusted, end-to-end heterogeneous design infrastructure internally is prohibitively expensive and carries a massive execution risk that could delay their AI rollouts by years.
Let me get this totally straight. So what you just said basically means Marvell is the indispensable toll booth for customizing AI infrastructure. If a tech giant wants a chip perfectly tailored to run their specific AI models at maximum efficiency, they simply don't have the time, they don't have the massive patent portfolio, or the complete end-to-end supply chain to do it all from scratch in-house. They are essentially forced to pay the toll and partner with Marvell to actually get it designed, built, and packaged correctly. That is a wild position to be in. But that brings us to the absolutely most critical part of our analysis today. Every toll booth has a bypass road eventually, right? Nothing in the stock market is foolproof. We've talked about all the amazing growth, the jaw-dropping 265% stock surge, and these massive revenue projections. But as an investor, I need to know what could blow this whole thesis up. Doctor, what are the fatal weaknesses here? What are the specific risks that could absolutely crater this stock and wipe us out? We must analyze the risks rationally based on current market vulnerabilities, exactly as identified by quantitative analysis from sources like Simply Wall Street. While Marvell's moat is undeniably their unique custom high-bandwidth memory compute architecture and optical dominance, there are two primary, fatal weaknesses that investors must monitor closely. First, customer concentration risk. A highly significant portion of their custom silicon growth narrative relies on Amazon Web Services. If Amazon shifts more of its proprietary Trainium AI chip manufacturing share away from Marvell to an entirely in-house solution or to a direct competitor like Broadcom, Marvell's custom revenue targets will mathematically fail. Second, macroeconomic dependency. Marvell's entire forward growth thesis assumes that cloud hyperscalers will continue investing hundreds of billions of dollars into AI infrastructure year after year without pause. If the AI capital expenditure bubble pops or even slows down slightly to digest current capacity, those data center growth targets are put at immediate critical risk.
That is genuinely terrifying. If Amazon simply decides to go in a different direction with their Trainium chips, or if Microsoft and Google suddenly tighten their belts and stop building new AI megacities, Marvell's entire plumbing business dries up almost overnight. Okay, so with this massive upside and these very real existential risks firmly on the table, we need to know exactly how to value this company right now before making a move. Let's look at the 3 survival scenarios. To provide clear grounds for making investment decisions, we have modeled 3 strict valuation survival scenarios based on the data. Let us begin with the bull case. These scenarios are not speculative guesses,
They are strict mathematical projections based entirely on current market data, forward earnings multiples, and the preconditions required for each outcome to materialize. The bull case puts the stock price at $370 per share, which represents a 68% upside from current levels. The trigger for this optimistic scenario requires flawless execution of their custom silicon strategy. According to consensus estimates cited in our research, if Marvell's custom chip revenues successfully exceed $10 billion, their earnings per share are projected to more than double, reaching $8.82 in fiscal year 2029. If we apply a forward earnings multiple of 42, which is perfectly in line with the broader NASDAQ Composites earnings multiple for high-growth tech, the math strictly dictates a $370 valuation. However, this requires the hyperscaler AI build-out to continue accelerating without a single interruption. Wow, $370. That is a massive potential upside for retail portfolios. But as you just pointed out, that requires absolute 100% perfection and zero slowdown in the AI gold rush over the next few years. Let's bring it back down to earth for a second. What is the most likely neutral path forward based purely on the guidance management is giving us today without any crazy euphoric assumptions?
The neutral base case is proven entirely by current management guidance and their existing already secured design wins. In this scenario, Marvell successfully executes on its current backlog without losing any major market share to competitors. The data points here indicate that their core data center interconnect business, which includes the optical modules and switches, will reliably double by fiscal 2028 compared to fiscal 2026 levels. Furthermore, custom AI chip revenue grows by over 100% in fiscal 2028 as current architectural designs finally move into mass production. This results in total company revenue growing 45% to hit $16.5 billion by fiscal 2028. This scenario assumes steady, strong demand, maintaining their current premium valuation, but completely without the euphoric multiple expansion modeled in the bull case. Okay, so the base case is still incredibly strong. I mean, hitting $16.5 billion in revenue implies a very, very healthy business moving forward. But we have to look at the dark side. We have to protect our capital. What happens if the fatal risks we talked about actually materialize? What is the absolute worst-case bear scenario?
The worst-case situation, the bear case, results in a severe market correction down to a fair value of $140 per share. This figure is derived directly from the quantitative discounted cash flow analysis provided by Simply Wallstead. This scenario triggers if the fatal risks materialize, specifically if Amazon shifts Trainium's share away, causing Marvell to miss its 20% custom compute market share target, and if hyperscaler capital expenditures significantly slow down. Under these negative conditions, the current market value of roughly $192 billion is fundamentally unsupported by future cash flows. The analysis explicitly concludes that at the current trading price, without flawless execution of the AI narrative, the stock is technically overvalued and would violently revert to its intrinsic $140 baseline.
Ouch. A drop to $140 would be devastating for anyone buying at the top today. It really highlights how much future perfection is already aggressively priced into the stock right now. So essentially, Marvell is walking a very thin high wire act right now. They undeniably have the absolute best technology for AI plumbing, but the market expects them to cross that high wire without a single stumble, without losing Amazon, and without a gust of macroeconomic wind. As the legendary investor Benjamin Graham famously said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Right now, the market is voting on Marvell's AI hype, pushing it up 265%. But in the long run, the weighing machine will only care if they actually hit that $16.5 billion revenue target and keep their hyperscaler clients happy. Doctor, thank you so much for this incredibly rational, data-driven breakdown. And thank you, the Focus Learners, for watching today's explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for us to keep producing these deep dives. But we have to leave you with this final, provocative question. If Amazon announces they are moving entirely away from Marvell tomorrow, are you prepared for that $140 reality, or are you betting it all on a flawless, trillion-dollar future? Let us know your thoughts in the comments down below. We'll see you in the next explainer.